Well, welcome everybody. Welcome to our economic policy panel discussion today. As you know, this was due to take place in Berlin, hosted by the German Federal Ministry of Finance, but we're not in Berlin. But the good thing about being online is that so many of you can join us today. So I know if you're studying or teaching, it's been a difficult month, difficult 6 months. And if you're involved in research or policy, well, you've got a lot on now. But I can guarantee that this is going to be a good use of the next 90 minutes, not just because of what we're discussing today, but who is discussing it. Our topic today is, should the European Union abandon the fiscal rules designed to put constraints on national budgetary policies and adopt fiscal standards instead? And that's the focus of a paper called Redesigning the EU Fiscal Rules from Rules to Standards. And we're very fortunate today to have all of the authors of that paper on our panel, plus quite a few other people. Now, if you are missing being in Berlin, just imagine us all behind a long table at the front of a stage. Okay, so who will be on our panel today? Well, first of all, presenting the paper today, we have Olivier Blanchard of the Peterson Institute. So Olivier, welcome. Good, that's great. And but also Olivier's co-authors are here later on. That's Alvaro Leandro from CaixaBank Research and Jeremy Zettelmeier from the International Monetary Fund. Hello to both of you. Let me tell you though what's going to happen and the order in which it's going to happen. Now in a minute, I will introduce Beatriz Veda Di Mauro, who apart from being the president of the CEPR, is also from the Graduate Institute Geneva and INSEAD. After Beatrice has welcomed you all, then we will have Olivier's presentation. That's the big event of the day. We have two people to discuss what Olivier is presenting today, and that's Davide De Bortoli of Università Pompeu Fabra, and also Michael McMahon from the University of Oxford. Hello to both of you. Give us a yep. And then also to discuss the policy implications of what Olivier has presented, we are going to have Jakob von Weizsäcker from the Federal Ministry of Finance, and Beatrice will be back for that as well. Now, following that, we will give Olivier a chance to respond to any of the comments, and then also we're hoping to get to your questions as well. So please do ask them all the way through. Also, go to that questions tab as well, even if you don't want to ask a question, and vote up the ones you think are most interesting. Then we can prioritize questions. I know what you're all thinking. How are you going to get that into 90 minutes? Well, there is a reason we're going to get it all into 90 minutes. It's because I have extracted a credible commitment to stick to time for all of our presenters today, and they're on screen now and they can nod and say, yes, we'll do that. So that means we will get through it in 90 minutes. That's enough from me. So first of all, I would like to introduce Beatrice to welcome the session.
Thank you very much, Tim. Thank you very much to everybody attending today, both the panelists and the audience, of course. I wanted to say a few words because this has been an event that was in my agenda for more than a year. I was really hoping to come to Berlin, not only because I like Berlin, but also because the economic policy panel and the economic policy journal are one of the real flagships for CEPR. And it's very important that this big project continues to be as successful as it has been, and I wanted to give it my full support. Economic policy is offering, and this is what the promise is, timely, authoritative analysis for choices confronting policymakers. And definitely there is no better demonstration of this ambition than today's panel and today's topic. When I look into the history of economic policy, it is already exists since 1985, and it was Georges Demenil and Richard Portes who first started talking about pooling efforts to create a new economic journal in Europe. they shared, the idea was to build bridges across Europe where frequently research and research centers were being perceived as being balkanized across countries. And also there was a big gap between scholarship and policy. Certainly this is still at the heart of economic policy, but also of CEPR, breaching those gaps and helping policy makers to understand what academics are thinking and vice versa. I'm very much looking forward to this panel. Economic policy, by the way, today is a collaboration, a European collaboration between CEPR, the CES-IFO, and Sciences Po, carried by those three partners. And so it is very much in this European spirit that we are trying to contribute. I'm looking forward to today's discussion, and I am absolutely certain that this will not be the last discussion we have about fiscal rules in Europe, but it may be an important one. So thank you very much for, again, all of you for being here, and over to you, Olivier.
Yes, it's probably, thank you, Beatrice. It's probably is a discussion where we can say in the future, we were there when Olivier presented his paper. So Olivier, I'll now hand over to you for your presentation.
Thank you, Tim. Thank you, Beatrice, for the very kind introduction. Indeed, it's an important topic, and I think it's really important to have a discussion. So as you said, this is a co-authored paper with Alvaro Leandro and Jerome, and I hope that they will answer some of the questions at the end. Let me just plunge and proceed. We've been discussing fiscal rules for a very long time, EU fiscal rules. Basically, from the introduction of the rules, there was a discussion as to whether they were the right ones or not. And as time went, there were violations by small countries, then by big countries. There were many modifications. There was, I don't know if the word really exists, but complexification of the rules. At the same time, the environment changed. And the rules, I think, were very much based on the Maastricht type spirit. And the economic environment changed in particular, and that's probably the most important change for this issue, is that the sign of the interest rate minus the growth rate changed from being positive to being negative. And that raises many profound issues about how to design the rules. Then came the COVID crisis, which has led to a suspension of rules, as I understand, at least until the end of 2021, which gives us some time.
Olivier, this is Jakob. I'm terribly sorry. We can't hear you very well. Is there any chance you could move closer to the microphone?
Yes, I mean, I have to be very close to the laptop.
Very sorry.
and so I'm going to try to stay as close as I can. I hope that my voice is okay now. Is it okay, Jakob? Let's assume
yes, I think it's much better.
Okay. So we have time. We actually have at least a year or maybe more to discuss these things and see what should be done. The result of a COVID crisis is a large increase in debt ratios, which might be even larger if things turn out even tougher than we currently expect. And so the question is, what do we do? How do we think about these rules? So the paper has a basic argument, and some of you may have seen an earlier version in which we were dealing with more issues than that, but we decided that the rules versus standards issue was the central one, and that's what this presentation is going to be about. So the proposition is going to be that sustainability is a very complex concept, and it's highly country and time dependent. The problem with fiscal rules, no matter what they are, is that there is basically no way they can capture the complexity ex ante, namely in the writing of rules. And so this leads to the following conclusion, which is, well, you have to assess things in situ, I would say, or exposed in that sense. You basically have to have fiscal standards, which are clear principles of what should be done, and then the right tools to see whether a country at a given time is basically on a sustainable debt path or not. And there is no alternative to it, sticking with rules will continue to raise issues which will not be solved. So this is a preview of the argument. So the next, I think, 4 slides are about that sustainability, because it is really at the center of what the issues are. And this slide is what I would call the traditional approach, which implicitly was based on a world in which the interest rate was bigger than the growth rate. So R minus G, to use algebra, was positive. The first point to make is why should there be EU rules? And in principle, why should countries not be left to do what they want to do? And in many respects, we leave countries to do what they want to do and not interfere. The issue, conceptual issue, analytical issue, is debt externalities. That basically, if you let countries do what they wanted, they might misbehave, they might take risks, which from their own point of view is their problem, but the risk might affect the other partners. The financial system might be affected. Claimants in other countries might lose from a default on debt. There might be pressure on the ECB, but that has to be the argument. If there were no externalities, debt or otherwise, there would be no point in having EU rules, I think. The second point in that respect, and I think a lot of the discussion is confused on this, is that therefore the purpose of these rules is not to make sure that that policy is optimal, but that it is sustainable. There's an important distinction. It may well be that optimal debt for a country is actually negative. If we care very much about future generations, we may want to leave them with negative debt. That's a decision of a country, and it should do whatever it wants to do. What the others should worry about, and what the rules should be, is that it should be sustainable. And so there's a clear difference between the two, and the issue here in that talk is sustainability. So let me go through trivial algebra for a while, just to clarify things. So the first item gives the standard debt equation, which you all know and have played with, I assume, in the past, which is that the debt ratio is equal to 1 plus the interest rate minus the growth rate times the debt ratio last period, say last year, minus S, which is the primary surplus or the primary balance, right? That gives the dynamics of debt. It has no content. It's just an accounting identity. So the question is, how do we think about stabilizing debt in that context? Well, what you must do is generate enough of a surplus, the primary surplus, to cover interest payments. So the surplus has to be equal to R minus G times D. If the surplus is less than that, then debt would explode, and that would be an issue. Now, again, that just, it by itself, it doesn't tell us what level of debt is sustainable or not, but it tells us that it depends very much on these elements. So I think the next step, and here I'm clearly simplifying a lot, is it's reasonable to think that there is a maximum primary surplus, that policymakers cannot generate more than X in primary surplus, and you can call this S max. Then how do we think of X max? Well, it's equal to the current surplus, which might be a surplus or a deficit, S, and then how much fiscal effort is economically and politically feasible. There's probably a time dimension. It may be hard to do it quickly, but maybe over time you can do more. Instead, you may have a big fiscal effort, but not be able to sustain it. Okay. That fiscal effort is going to be a function of many things. It's going to be a function of a political system, the ability of a government to actually do drastic things. So whether it's a coalition government or not will matter. It will depend on the tax burden to start. If you start from really high tax burdens, it's going to be very hard to go further. And so on and so on. But given this S max, then there is indeed a maximum level of debt that you can sustain. So sustainable debt, D max, which is equal to X max divided by R minus G. I think if I had given this talk, say, 20 years ago, this would have been it, more or less, but it already has really big implications, even when R minus G is positive, which is you can see that the determinants of D max depend on are many. It depends on S-max, which depends on political reality. It depends on R, it depends on G. And therefore, the notion that there is a uniform 60% number, even in that context, is basically not the right way to think. The degree of the level of sustainability of that depends on all these factors. Now, the next slide reflects the fact that life has become more complicated, or intellectual life and policy life has become more complicated, because we have moved from a world in which R minus G was positive when the rules were introduced to a world in which R minus G is negative. This has been a trend. It has been accentuated by COVID, but it is a trend, and it's a very strong one. Now, the question is, when you actually go back to the equation, you get strange results. The first one is that you can maintain a level of debt ratio, debt to GDP ratio, with a primary deficit. You don't need a primary surplus. This is because R minus G is negative, right? So you can have a primary deficit and the debt ratio will not increase. But the statement is even stronger, which is you can have any primary deficit and that will not explode. It might increase for a while, but it will not explode. And so in that sense, in the limit, it's very hard to think of, well, what is a sustainable level of debt? Any basically primary deficit is associated with eventually a stable level of debt. Now, stopping there and saying, well, any level of debt is fine is clearly not the right answer. But the question is, why is it not? Okay, so I think there are two reasons to think that one has to be careful here. The first one is, if we were to increase debt by a lot, then it would lead to an increase in the safe rate. Now, whether it's the increase in debt in the country or the increase in debt in the world, that's to be discussed. That effect is there. There is a level of public debt so that R minus G would become positive, and the previous slide would just be fine. The relevance of that argument is not zero, but it really, given the estimates we have about the effect of debt on interest rates, it would have to be a very high level of debt before we actually have to worry and R minus G becomes positive. I think the main argument for being careful is second moment, which is that we're not sure that R minus G will be negative forever. The probability may be small, and the market suggests that it is indeed the case, but it's not zero. And so we have to be ready when we think about that sustainability, about the outcome in which R minus G reverses, becomes positive. And if D is very large, then you need a very large swing in the primary balance, right? If R minus G increases, say, by 4%, and you have a debt ratio of 200%, then you need to generate 8% of GDP to avoid the debt explosion. So there's clearly a limit which comes not from the first moments, which was the previous slide, but from the second moments. And so then you still get a D max, the maximum level of debt, which depends now on the distribution of R minus G, how likely it is to become very large. So if you want basically to take the 1% up in the distribution and call this R minus G max, and then the maximum level of debt is given by this equation, which is, in that case, you want to be able to generate a primary surplus sufficient to generate the level of debt. So I think that in the kind of world we are, this is the way to think about debt sustainability. It's clearly very different from the way we thought about it in the previous slide. The point to make here is that debt sustainability is a probabilistic concept. Uncertainty is of the essence. You cannot be absolutely sure that debt will be sustainable with probability 1. The example of COVID. COVID is a 3 standard deviation shock in terms of 4 standard deviation shocks in terms of deficits, perfectly justified spending, but it's very, very large. And you can think that if we don't find a vaccine, then it may be that we have to run deficits and it lead to a positive probability that that is not sustainable. So that sustainability is really the proposition that that is sustainable with very high probability. Okay. 2 more slides on that sustainability. If I've convinced you that R minus G was negative and was likely to remain negative for a while. This is empirical evidence. So as we know, if we just take the expected values as reflected by the yield curves, as you can see, the yield curves are far, the expected R is much below any reasonable forecast for G. This is true for the three countries at the bottom, which are Germany, France, and Spain, up to 30 years. But it's even true for Italy, which basically, you know, the yield curve says 2.5% in 30 years. It's very likely that the nominal growth rate will be at least equal to that or higher. Now, that's just expected values of average beliefs as reflected in the yield curve. What's at the bottom is the implied probabilities from option prices on these various instruments. And I just want to point your attention to the last column, which is what is the probability that investors put on the nominal interest rate being more than 4% in 5 years. It's basically less, it's 1% or 2% at most. So they're extremely convinced. They may not be right, but they're extremely convinced that this is now going to happen. And to the extent that we have had this long trend, and it's hard to think of why it should reverse, I think that a more structural approach leads to the same answer. Now, last slide on debt sustainability. Well, what about the argument that debt is dangerous because there's rollover risk? Even if you tell me, Olivier Blanchard tells me that, you know, it's sustainable, what happens if investors believe that that is unsustainable and they ask for a spread in order to compensate for the perceived risk? We know that can happen. We call this multiple equilibria or sudden stops or whatever, but we've seen it happen in other countries. We've seen it happen in emerging markets. The question is, what are the implications of this for debt policy? And I think the answer here is it's not clear, because when you work with models in which you try to find what is the range of multiple equilibria, you find that these multiple equilibria can happen at very low levels of debt. And conceptually, they could happen at very, very low levels. But in practice, and I think in theory, it's likely to be a fairly large range. To give you a number, it may happen at 40, 50% of GDP. We're currently at 100%. The hope to get to 40 or 50 is unrealistic. So it is an issue, but it is not an issue which leads you to say, okay, so let's stay under 100%. At 100%, the risk is there. 60%, the risk is there. I think what the answer here has to be is that it's the role of a central bank as lender of last resort to actually avoid the bad equilibrium and intervene when investors, for no good reason, decide to sell. This is what the ECB has done with Italy, and I think that's what the ECB should be doing. The ECB cannot solve all problems there, but again, I think this is more an issue of how the ECB intervenes, and when it does, then about the level of debt. So that much for debt sustainability. The argument was it's a really complex issue, and you have to take all these things into account. Now, the next part is about the existing EU fiscal rules, and it has been described as sedimentation over time. This is not from us, and increasing complexity. And we have put in the paper this figure, which is the Cathedral of Seville, which is a good indication of just adding and adding and adding stuff. I wish the EU rules were as nice as the Cathedral of Seville, but they share the same characteristics in at least that way. I'm not going to spend a lot of time on the EU fiscal rules, and most of you probably know the basics, and the details are incredibly complicated. We really spent a lot of time trying to understand them, and I'm not sure that we do. Alvaro, who is one of the co-authors, was amazing in reading the 160 pages which explain it. What you need to know, I think, is we're not arguing with the complexity per se. That's not the issue. Behind this, behind the current rules, there is still the central element, which is as a target, the 60% debt ratio, which was there at the beginning and is still there. Now, the rules understand you can't get there right away and so on, but it's still central. And the way it does it is by saying, well, if you're not at 60%, you basically have to get there in some way, right? And so it's based on two legs. The first one is the structural balance leg, which says a structural balance, which is cyclically adjusted, but has interest payments in it, as opposed to a primary balance we had before, must be less than some medium-term objective. The medium-term objective is itself a maximum of 3 different limits, but conceptually, it basically is such that the economy, the debt should return to 60% at some rate. Because people are not terribly happy with the output gap and therefore with the cyclical adjustment, they have introduced, or the EU has introduced an expenditure rule, which is expenditure should not grow too fast. And that under some conditions basically leads to the same result. The two rules are not exactly the same. They kind of approach the problem from two different ways. It's thought that by doing so, they avoid some of the issues. If the countries don't satisfy the conditions, then there's a corrective process, which is called the excessive deficit procedure. And again, it's basically a way of getting countries towards 60% and 3% deficit ratio. There's some flexibility, and the most extreme one is the one we've seen with COVID, which is the suspension of a rule. In particular, fiscal adjustment can be slower. The target remains the same if output is very low. There's a large negative output gap. You don't need to adjust as much as you would otherwise. Now, if you compare the EU rules to the kind of analysis that I've presented in discussing that sustainability, you can see that there's a world of difference. With respect to the first one, with respect to R minus G, I hope that you're convinced that R minus G is absolutely central to the level of debt which is sustainable. Well, the debt target in the EU rules is independent of R and G, at least of R. G, but no, N of G as well, actually. So R minus G. The adjustment itself is nearly independent of R minus G. So not only is the target the same, but the adjustment is nearly the same, no matter what R minus G is. The adjustment with respect to output fluctuations, then there's a bit more flexibility. The medium term, the MTO target is about cyclically adjusted deficit, and therefore it allows for automatic stabilizers, which is good. And the speed of adjustment of the underlying structural deficit can be slowed if output is very, very low. But it cannot be reversed. You cannot increase the cyclically adjusted deficit, even if output is in depression. So if rules are to be kept, which is not unlikely in some form, then you need, I think, modification, at least at both margins. But what we argue in the paper, and that gets to our proposals, is that we don't think the rules should be kept. And the reason is that, as you've seen, at least I hope I've convinced you, that the number of relevant factors to say whether debt is sustainable or not is extremely large. It's very idiosyncratic in the sense it depends on the particulars of a particular country. And so there has been movement among the people who are thinking about revising rules towards simplification. Let's just use an expenditure rule. Or instead, no, we actually have left out some case, so let's complexify. So we use the word, but that's what they mean. And we think that neither one is right. You're basically dealing with an extremely large set of contingencies, most of them very difficult to think about ex ante, and therefore this is not the way to go. Now, one could basically stop here and say, well, just give up. We don't think that's the case. We think that fiscal standards can actually do the trick. So let me spend the last 4 slides on standards. Standards is an old standards versus rules is an old discussion in the legal literature. When should you basically have rules ex ante, legal content ex ante, or mostly exposed, in situ at the point of application? So I give 2 examples here. One is in the paper, which is if you're worried about people going into trees, you can put a 50 miles an hour limit and people will just respect it, and fewer people will die. Or you can have a general principle, which is, well, do not drive at excessive speeds, and then you assess ex post whether this was the case or not. Another example is much more relevant at this point, is wear a mask, right? So one way of doing things is have a rule. You wear a mask, no alternatives. Or you can say, no, be careful about protecting yourself and others. If you're in the street where there's nobody else, you don't need a mask, and so on and so on, right? Now, the choice is going to depend on the complexity of the issue, the ability to identify the contingencies ex ante. And I think we're, in this particular case, facing exactly the case where ex post is needed and ex ante cannot work. Now, is this a crazy idea? Well, with respect to the EU rules in general, there is a part of the EU construction which is based on standards, which is competition law. It doesn't say firms have to have less than 1,000 workers or anything like that. They say we're going to look. There should be monopoly power. And standards actually, now looking at fiscal policy, standards actually exist in fiscal policy. The main example is New Zealand, which has had principles of standards since 1994. It has a series of principles. I just put one here, which is the main one: achieve and maintain prudent public debt level. So the argument that cannot be done, the New Zealanders are quite happy with this, and therefore it can be done. Now, 2 slides on implementation. I don't know, Tim, how I'm doing on time, but I assume I have time.
You are close to time, to be honest, but we're doing pretty well, yes.
Okay, so 2 slides on implementation. So what it needs, if you go the standards route, is a principle. So member states should avoid excessive government deficits. This is Article 126 of the treaty, right? You need a tool to decide how to do things. And the tool we think is appropriate, it's not the only tool, but it's a main one, is stochastic debt sustainability analysis. You basically try to see what debt and the primary balance and the structural balance and so on will be over the next N years. And the stochastic part is that you take into account the uncertainty about what may happen to growth, what may happen to interest rates, what may happen to policy decisions and so on. And then at the end of N years, you look at the distribution of debt and the distribution of the primary balance, and you see whether there is a risk that the primary balance that comes out is inconsistent with stabilization of the debt at that point. So the point of it, again, we could spend a lot of time, but time constraints are there, is it's not, there are going to be many assumptions, but there has to be assumptions. This is a difficult issue. I think it's the right way, we think it's the right way to organize the discussion, right? So what would be the actions triggered by the tool? Well, suppose that the stochastic, the SDSA says that doesn't look sustainable with high probability. Then if it's sustainable, you say no action. If it looks like it's not sustainable with high probability, then the country needs to adjust. Basically, the speed of the adjustment is determined by the usual trade-off between output stabilization and risks. One more slide, and then I'll do it, which again, could be a very long discussion and may have to be a very long discussion if anything like this happened, which is how do you enforce it? In New Zealand, it's done through, there is a fiscal strategy report, then the parliament discusses it, there's public scrutiny. That wouldn't work in the EU because nearly by definition, the EU is going to ask countries to do things that they don't want to do, that their parliament doesn't want to do. So that doesn't work. You can rely on market discipline, and I think the stochastic analysis can help a lot, and making it public shows how things look, and it can trigger a market reaction. But I think it comes late, too late. So let me just mention 2 options, and we can come back to it. I think in both cases, the Commission should do the work of preparing the SDSA and discussing what it implies. Make a recommendation that maybe the country should have a lower deficit over N years. Then the question is, do you basically ask the way it's currently done, the European Council to approve or not, and then the decision is left to the Council, or do you basically go the other way, the judicial way, You use something like the European Court of Justice. Maybe you have to have a specialized body because economics is not their thing. Maybe the European Fiscal Board becomes more powerful and does the job. There are pros and cons. I'm going to pass because of time. And the concluding remarks. So, we're aware that it will probably be a change in rules, but we think we should try, and maybe something happens. There are going to be adjustments at the margin. Whether it's going to be simplified or complexified, probably simplified, but it's not going to work, right? So the last slides are, well, we just described methodology. What are the likely conclusions if an SDSA was done at this juncture? So here I'm talking for myself, not for the fund or for Jeremy. I think that the conclusion would be that that is sustainable in nearly all countries with very high probability. But as I say, I would respect the exercise and I would want to see what the SDSAs actually tell me, but that would be my guess. Last remark, going back to a remark at the beginning, I've not talked about optimality. I've talked about sustainability. And the discussion of optimality of deficit policies at this point is central as well. It's a completely different discussion. So let me stop here and thank you for listening to me.
Thank you very much, Olivier. That's New Zealand is held up as the exemplar of so much that's good at the moment, doesn't it? Yeah. Now, one thing that you could do, Olivier, is just have a look at some of the questions that will come in, because we do have some very good questions and they deserve a reaction later on. But first of all, we have to move to our discussants. So Davide, I believe that you're first, if you would like to present your reaction to what's just been presented to you.
Yes, so thanks a lot, Tim, for this introduction, and thanks for the organizer for giving me this opportunity to discuss this excellent paper, and which I've enjoyed reading. So this is a good time to rethink about EU fiscal rules. And there are nowadays several proposals suggesting changes in different directions, either in terms of more complex rules or simpler rules, and so on. So this paper offers useful insights and contribute to that debate along several dimensions. It first discusses the limitations of the current rules or the current targets. And among many other factors, the most important criticism is that there does not exist a magic number or a set of magic numbers that would work in any situation. And for this reason, the authors propose to move to a different framework, to a different conceptual legal framework, that is to specify what they call standards, or, if you want, we can think of qualitative predictions to limit excessive debt accumulation. So, for instance, the law could just state that we should avoid excessive deficits. And from a practical perspective, the paper proposes a tool, an analytical or quantitative tool, to determine when debt or deficits are excessive. That is called the stochastic debt sustainability analysis. Now, this stochastic debt sustainability analysis, what is telling us is that whenever we want to think whether deficits or debt are sustainable, we should take into account a variety of factors. We should not stick to a single number. We should think about factors like the growth rate, interest rates, what are the maximum fiscal effort that countries may be able to sustain. And also, we know that all these elements are interrelated among each other. We know that they are subject to lots of uncertainty. So this may look something very complex, but actually I don't think this is the main limitation, the main problem of the current proposal. I think actually the type of complexity that is underlying this type of analysis is comparable to the complexity of other analyses that are performed in different realms of macroeconomic policies or other types of policies. We think about monetary policy or we can think about competition policy and so on. So I actually think this is actually a good tool, the right way to approach this type of problems. So what I'm gonna focus on this in this discussion are two main comments. On the one hand, I would like to emphasize how regardless of how we specify fiscal limits in terms of standards or in terms of rules, a crucial aspect is to take into account to what extent these limits provide credibility, provide some discipline, and to what extent they limit the flexibility to respond, say, to economic shocks. And what I'm going to do next is to assess or to provide my thoughts about how the adoption of standards will alter the balance between these two objectives, credibility versus flexibility. The second comment is a more general comment about the EU architecture. The focus of the current analysis and the discussion today is mainly on the fact that fiscal limits provide a burden, constitute a burden to provide insurance against the macroeconomic shocks. I'm gonna take a slightly broader perspective and relate this observation with the fact that another problem is also that the euro area could be characterized, because of the current architecture, by excessive risk. Okay, so it's not just a problem of lack of insurance, it's also a problem of too much risk or unnecessary risk. Okay, so let me get started with the first comment, so credibility versus flexibility. Let me ask the first question. If you compare standards and rules, which of the two is more credible, provides more credibility? Of course, to answer this question, we first need to provide a working definition of credibility. So in fiscal policy, in general, we tend to think about credibility along two dimensions. One is that credibility is whenever the announced policies are expected to be actually carried out. This is what is referred to as time consistency. Or the second is, well, actually it is in terms of credibility of debt, is that it is expected that governments will honor their obligations. There will be no default. So if you think about rules and according to these two criteria, as a matter of fact, if we look at the performance of the rules, the 3% deficit rule or the 60% maximum debt, we immediately see that these rules have been often violated, exposed. There has been no sanctions, and in practice, it is not simple to determine what are the actual limits, given the complexity that the paper and the presentation, the earlier presentation was alluding to. So the second, if we think about the credibility in terms of honoring that obligation, avoiding default, I think the current rules are quite effective in terms of correction exposed when the situation, when countries have already accumulated a large amount of debt or accumulated large, run large deficits, more than prevention. That is what is actually would be more useful if we want to avoid the future defaults. And the clear example is that it could be that today the deficit is below 3%, the debt is below 60%, but because of the presence of high interest rates or low growth rates, actually debt is on explosive pattern. The current rules will have a little scope to prevent this type of situations. And instead, standards, since they are by definition defined to be applied on a case by case, they are because of their nature, they are less likely to be violated ex post. If you have a state contingent plan about what countries should do, it is less likely that a limit is violated if this limit is adapted to each situation. And second is also that this standard seems to be more effective as prevention, because by definition, if we adopt as excessive debt criterion that default should not happen more than say 5% of the time, by definition there will be a low default probability. Of course, the devil is in the details, so credibility might improve actually if we adopt standards, but of course it is important, what seems crucial, is that these standards are accompanied by a transparent set of criteria describing how this analysis will be performed. And also another aspect is that it is important to define who is actually, where is the burden of proof, whether it is the European Commission having to prove that debt is unsustainable with some probability, or the single country has to prove that debt is sustainable with large probability. Depending on where where the burden of proof is allocated, the eventual ruling will completely change outcomes. Obviously, if it is on the EU side, the Commission side, it is less difficult to impose these limits. If it is on the country, single member country side, it will be easier to impose these limitations. Okay, the second is about flexibility. So, would standards admit larger debt or deficits? Would they allow countries to respond counter-cyclically to macroeconomic shocks? Well, here the paper proposes a simple way of assessing this possibility. So here I'm just reusing their example. Imagine we have a current situation with a growth rate of 1.2%, is the average of the euro area in the past 20 years, that the maximum surplus that the government can sustain is 2% per year. And then the interest rate is obeying a simple equation, that is, is what the authors use. Here I've just slightly adapted the numbers in order to make the current real rate equal to what is the German interest rate under a debt of 60% of GDP. In that case, the debt limit, the maximum sustainable debt, is large, is 192%, much larger than 60% than the rules. All right, so this suggests that there is more flexibility, but this is not the end of the story. We need to take into account risk. So here I propose a different exercise. So in the spirit of the stress tests that are conducted, for instance, for stability in the banking sector. So suppose we want to analyze what would happen if the interest rate raises by 350 basis points for a period of 5 years. Now, we can debate how likely is this event. I use this as a benchmark because it is more or less the situation we had in, say, from 2010 to 2015. It may or not happen again. This is subject to debate, but I just want to provide an example. So the question is, under which conditions would debt be sustainable? So after 5 years, would be debt below B bar. And here is a graph. So this graph shows in the conditions, that is initial level of debt on the horizontal axis, and the primary deficit on the vertical axis. The white area are combinations of these two conditions such that a country would pass the stress test, and the gray area is when a country would fail the stress test. So let's just compare this with the situation of Italy in 2019. Italy in 2019 has a level of debt slightly above 130%. Italy would pass a stress test unless it will suffer a deficit of more than, say, 6% per year. However, if next year the IMF forecast is that Italy will have a debt above 160%, and in that case we see that Italy will hardly pass this stress test. So this is just an example to highlight that perhaps it's not totally obvious that there will be more flexibility if we add this. If you adopt these standards rather than the current rules. So let me briefly now move to the second comment. And this is about the EU architecture. So most of the discussion so far has been on the fact that these current rules, or even the proposed standards, may limit the possibility to insure against adverse macroeconomic shocks. All right, this is a combination of the constraints of monetary policy and fiscal policies and so on. But actually, I think another important aspect, another important problem in the European Union at the moment, and specifically in the monetary union, the euro area, is that the common currency, the fact that there is a common currency may generate excessive risk for individual countries. Here, I'm repeating arguments that have been widely exposed by a variety of authors, One problem is related to the absence of a lender of last resort. It is not clear whether the ECB should act as a lender of last resort for individual member countries. And this may generate the multiple equilibria that were mentioned earlier. Second, there is a phenomenon that is called, I refer to as financial disintegration. What do I mean? Is that it seems that financial integration is per se counter-cyclical. Capital flows are high, there is high integration during good times, if we look at the period between 2000 and 2012, but then there is a reversal of capital flows in the aftermath of the financial crisis. And this contributed to generate additional risk for the member countries, and actually for countries perceived to be weak, it will be very difficult to implement counter-cyclical policies due to the fact that the borrowing cost becomes much larger. So the third aspect is that there is inadequate risk sharing, and in principle, this idiosyncratic risk could be reduced through some common actions, a common budget or special funds, which is the direction that is that has been taken in recent years, especially now with the approval of the recovery fund. So just to put it into to use the same reasoning of the authors, I don't think necessarily the main problem is that the EU rules are the cathedral of civil. I think an important problem is that the EU architecture looks like the Sagrada Familia. It was started as an ambitious project in 1920, and today, as you can see on the right, is still an incomplete project. It improved, but it's still incomplete. Okay, so I think I can stop here and conclude and say that I agree with the authors on most of their points. We need to rethink about fiscal rules. Stochastic debt sustainability analysis seems to be a very useful tool. I think actually the main concern could be that it may reduce credibility, but there is some good reasons to think that the credibility may actually improve. It is to be determined whether there will be more flexibility. But as a final remark, I want to reiterate that this is not the only thing that needs to be changed. Arguably, improving risk sharing will also limit the current problems of associated with fiscal rules.
Davide, thank you very much. There are more cathedrals than I'm used to in these sessions, but I think that's probably a good thing. Michael, now we move to you for your response to what's been presented today.
Okay, thank you very much. Let me just make sure I share this and hope it appears. And now if I go full screen, oh, no, that's spinning it. View presentation. Okay, can you still see this?
That's absolutely fine. That's great. Thank you.
And it's moving. Okay.
And it's the right way.
Well, yeah, excellent. Thank you very much. Very honored to read this great proposal. Given the content of it and given that I'm a member of the Irish Fiscal Advisory Council as well as being an academic, I think it's particularly important that I stress the usual disclaimer that these views are mine and do not necessarily represent those of anybody else. Okay, this is an incredibly important issue in macro policy, particularly in the EU, but actually more widely, I think, as well. So it's incredibly timely. As we all come out in a post-COVID world, and we have to think about, what are we going to do with the stockpiles of debt, and what sort of are the mechanisms that are going to guide the sort of political decisions that have to be made around those. I sort of boiled down the presentation, which Olivier presented very well, into two main things: replace current fiscal rules with fiscal standards, and then assess compliance with these standards using stochastic debt sustainability analysis. So to summarize my sort of view, yes, I sort of behind the move to fiscal standards, but I'm going to raise a number of challenges that I think are going to come out as a result of that. I'm probably less convinced on the move fully to stochastic debt sustainability analysis. I think it could easily be one of the tools, but it doesn't sort of seem obvious to me that if you're going to move from sort of fiscal rules to standards, that you don't want to take a sort of more broad approach, suite of models, and apply some discretion as well. So, okay, but overall, I agree. I think that's the key thing to get out. So my comments are going to be split. Really, I'm going to focus on what I think is the key message here about the sort of importance of flexibility in assessing fiscal prudence or fiscal sustainability. And I'm going to use a couple of examples of where rules have been either too rigid or just generally unhelpful. I'm going to talk about how we could implement a move towards standards, but there are some really important issues that I think still would need to be worked out. And then I'm going to sort of leave with a final slide on, well, if we're going to do this and we're going to reopen treaties, well, heck, there's a bunch of other things, much in the spirit of Davide's, let's not just think about one part of the project, let's get the full architectural plans out and let's look at everything. Okay, so I first came across the issue of debt sustainability analysis from this paper 20 years ago now. And I remember the point it was making because it was making it in such a beautifully simple framework, but it was making exactly the point that many have made since and is also being made in this point, which is, if you have high growth and interest rates relatively low, you can sustain much higher levels of deficit for a given amount of debt as the target. And at the time, the examples in the European Union were Ireland and the soon-to-be accession countries, because they were had a bit of an infrastructure gap to make up, but also had relatively high nominal growth rates and relatively low interest rate charges. So I wrote a paper related to this, basically saying nothing new. I often describe it as a sort of published rant about that. And it includes this table, and a version of this table was done by both of the presenters before, which basically just says that depending on the level of debt you start with, and depending on this fee parameter, which measures the relative R minus G, depending on those conditions, the primary deficit that will stabilize your debt. Now, this is, again, building on Olivier's presentation, nothing about what's optimal. We don't have anything to say that 60 or 40 is optimal. But if you want to stay at that debt level, it tells you what primary deficit you can run. And it varies massively depending on these conditions. And I think that's the point. So I sort of wrote it sort of making the point that, these 60 and 3% are not universal best practice. They don't guarantee sustainability, or they don't represent prudence. And so, in fact, you need flexibility both across time and across country. The other point I tried to make, though, was that the DSA framework is exactly an accounting framework rather than a macro model. And I think the big challenge with all of this is we have to think very carefully about endogeneity. Again, coming from Ireland, where we had debt to GDP ratios dropping very quickly because of our high growth, we entered the financial crisis. That fee parameter very quickly switched as debt costs went up and growth went down a lot. And suddenly, when you add in contingent liabilities, you get this big boost to the debt levels, and debt can go from very sustainable to very unsustainable. So endogeneity is really key to think about. And also the endogeneity of how the economy behaves depends on, obviously, the policy choices, but equally, the effect of policy can depend on the state of the macroeconomy. So we know of the sort of idea of fiscal multipliers depending potentially on, say, being at the zero lower bound or not. But equally, there's an endogeneity of markets. Markets understand different policies. If a government goes out and tries to do something incredibly imprudent, markets will react appropriately. We'll see interest rate costs go up. If they instead do something that's going to boost growth, that's really beneficial, and markets are not going to react to that. And so context also matters in that regard. And the last point there, which I won't touch on today, is all about how the narrative of household accounts being equivalent to fiscal accounts and how wrong that is, but how well it took hold in the UK in particular. But anyone who's interested can read that article. So that's how I saw the article. This is how the Irish press saw the article. I got labeled as a deficit-friendly economist. I don't even know what a deficit-friendly economist is. I think it's just somebody who understands these different dynamics. So at the heart of all of this is really flexibility. That's what I see at the heart of this proposal. Essentially, it's hard to write rules that apply to all countries and don't need to be adjusted as the state of the economy evolves and as individual circumstances evolve. Now, if I was the European Commission presenting here, they would argue they are somewhat flexible. And so Olivier revealed in his presentation that it wasn't him that suffered this, but if you want to know how flexible they are, pick up this document. It's the Vademecum. It's the 160 pages, which is both an attempt to lay out all the state contingent possibilities and how they will treat them, but equally it adjusts from year to year, although we haven't had an adjustment this year. So there is some flexibility in that, but you might want to oxymoronically refer to it as rigid flexibility, since this does not work very well. So let me give a couple of examples of where the rules really did not work well. So there was a case in Ireland in 2015, before my time on the Fiscal Council, where the rules were such that the Irish government had to submit some numbers. On the basis of those numbers, because they were in the adjustment phase of the excessive deficit procedure, they were told that they needed to adjust the structural balance by 0.6%. Between then and the budget, conditions in Ireland improved quite a lot, and there was a big increase in the amount of revenue. Now, this increase in revenue was subsequently spent by the government. They didn't spend all of it, but they spent a big share of it, such that by the time the budget came around, the deficit would improve by 0.8 rather than the sort of target of 0.6. That sounds good. Well, not really, because if you applied the same rules to the better economic conditions, the improvement would have had to be more than 1%. But of course, this was what I would call a violation in the spirit of the rules, but not the letter of the rules. They were spending extra revenue on current spending. Now, you may say that's just the way the rules go, but I think it's more damaging that. They are rigid rules, but equally there is this sort of view that these rules are actually capturing some sense of prudence. There's this article in the Irish Times referring to it, and the journalist wrote, rules are rules after all, as if this is some measure. But it also created a lot of damage, because when the Fiscal Council at the time, and this is not me they're referring to, but pointed out that this was not in the spirit of the rules, they were forced to reverse that position. And, there's reputational damage to an independent sort of fiscal assessor at that moment. Another example, the famous 26% GDP growth, which nobody sort of argues is sort of genuine underlying domestic demand growth. If you built that in, you would get this large positive output gap, which would, of course, badly affect the interpretation of the structural balance. No problem. The Commission could adjust potential up as well, so that the structural balance is unaffected. Flexibility, excellent. Except in the other leg, the expenditure benchmark, that's based off an average of the potential growth rates. So suddenly you have a 26% growth in potential. That's automatically adding apparently sustainable extra, spending growth room for the government for a number of years going forward, because this is a rolling average. Eventually that also got fixed, but again, only after a letter was sent by the Fiscal Council to the then Director General of the Commission. But it's not just in the positive, it's also happened when, after the financial crisis, the estimates for potential growth were very negative. So again, these rules, applying them sort of indiscriminately, can be quite dangerous. So as a result, the Irish government has, the Irish Fiscal Council has actually moved to assessing the domestic budgetary rule using a principle-based approach. So, the European Commission still assesses the Irish position with the EU fiscal rules. We have our own domestic budgetary rule in legislation. These were the same until 2019. Now we take a flexible approach. I don't think it quite goes as far as the standards, but it's certainly more in the spirit of the standards. Okay, let me just touch briefly then on a couple of the challenges. One of the challenges of the proposal is complexity. Full stochastic DSA is not trivial. I already sort of mentioned it, how do you build in the fact that the market risk, an increase in debt because it funds a big investment project that's going to pay off with higher growth, versus a big spending on sort of frivolous, the example was golden shoes for every minister or something like that. Markets would react very differently to that. And of course, that's difficult to bake into a DSA like this. How do we build in the fiscal multipliers? In some sense, this is a very technical question, but I'm imagining this highly complex multinomial distribution of all the possible parameters and how they're linked and the covariances between them. And so I think that's a difficult job. it's not obvious to me, and I think the authors were pointing at this, it's not obvious that most ministries of finance are necessarily best placed or equipped to do it. And the point I raised at the start, even if we do have someone do it, why rely on one tool? You know, I do think there's a role for a suite of models, as we would talk about in the monetary world, you know, and then this application of a case-by-case discretion. And for that, I do think that the independent fiscal institutions, the fiscal councils in each of the countries, could play a very important role. Okay, second challenge is communication. In a sense, this is a mirror of the problem that central banks have faced. A nice thing about 60% and 3% is they are very nice numbers that you can carry in your head and they can be communicated very easily. Standards may become more complex, and communicating a sort of dynamic, a stochastic DSA would be even more challenging to many people. Central banks are going the other way. They've traditionally had a sort of inflation target, which is easy, but then their analysis has been much more complicated. They're moving to a world where they're trying to now address a less technical audience. But one thing that we still struggle with in that realm is how to communicate uncertainty well. Fan charts seem to do pretty well, but even so, both for central banks and for, you know, many fiscal councils present scenarios, there's still this focus on, you know, the ranges are for cattle, show me a number. You know, they focus on a central case as the sort of main thing. The final point I want to make, and I thank Tim for applying standards rather than rules in his execution of the time constraints, is what is the appropriate horizon for all of this? You know, it's certainly clear we do not want to assess the fiscal position and fiscal prudence and sustainability on the basis of a very near future. And in that regard, the sort of decision by most governments in the European Union to sort of not provide budgeting beyond the end of next year is, I think, a bit of a disappointment. Even if we do have sort of very high levels of uncertainty, understanding how the government might react to different scenarios beyond 2-3 years is actually very useful. And I think we should certainly encourage medium term. But even more important is this sort of the almost iceberg in the sort of near distance of the longer term challenges, in particular those that come from aging and climate change. Now, we just completed in Ireland the first ever long-term sustainability report for the Irish economy. And Irish debt dynamics are incredibly favorable for the next 20 years. So you can see in this chart here that even though COVID will add a big sort of level to the debt, the dynamics, once we come out of sort of those problems, will still be favorable. The sort of natural dynamics will pull the debt to GNI star ratio down. But 20 years out, and almost perfectly predictably, almost in a deterministic sense, there is of course some uncertainty about how things like interest rates and the growth rate will evolve, but aging is happening in a deterministic way. The costs of that, unless policy changes, can be quite well predicted. The debt dynamics turn, and they turn quite quickly. The problem with limiting analysis to even a 5-year horizon is that that's 4 sets of 5-year horizons where politicians can sort of ignore that iceberg which we are gradually sailing towards. Okay, so let me finish with this sort of broader question. If we're going to open treaties, let's remember that the ECB themselves are doing a strategic review at the moment. You know, their primary mandate is also baked into the treaties. Olivier mentioned the idea that the lender of last resort could play a role at preventing the bad equilibria. Davide rightly questioned whether or not we have certainty as to this extent to which the ECB would do that. Given that in a world of sort of higher debt going forward, the issue of monetary and fiscal interaction is going to be continually important. Do we also want to have a bigger re-examination of the EU macro policy architecture? I'm sorry, Tim, I did not include neither a picture nor architectural plans of a cathedral in this, but that's what I had in mind here. So summarize, great paper, incredibly timely. I certainly support the push for flexibility, and if that comes through standards, absolutely, it's difficult. There are challenges. I'm yet to be fully convinced on stochastic DSA as being the only kind of way of assessing it, but as part of a suite of models, I say why not? Thanks very much.
Okay, thank you very much, Michael. Deficit Fredley McMahon, a reminder as well that in Ireland, macroeconomists are public figures, aren't they? So that was very interesting as well. And now we move to our other panelists looking at this from a policy point of view. Jakob, what would you like to say in response to the paper?
Yeah, Tim, thank you very much. I actually want to start by saying we would have been delighted to host CEPR at the Ministry and still very much hope that this is going to happen next year. I think we have plans to make that happen. But given that we are not in one room, I think it's a wonderful discussion we are having anyway. The reason, of course, why this is a timely event and a timely paper is that compared to the time when the fiscal rules were slowly but surely invented and then developed, we have two new things. The first is very likely low for long interest rates. And the second is, of course, after two major crises, on average, significantly higher debt levels compared to what the creators of these rules had in mind. And so they are, the big question, of course, is given these two changes, and as has been alluded to already by Michael and others, they're major changes, and not only has to do with fiscal policy, but there's sort of the question, how much can monetary policy do for stabilization? Fiscal policy clearly in this environment needs to play a bigger role. So there are all kinds of really, really big questions at stake. But the question we're discussing here is, are our fiscal rules fit for purpose? And there, I really liked the picture that Olivier was showing of the Sevilla Cathedral, which of course is more than 500 years old. And in many ways also gives us all the option. One option is, of course, as circumstances change, you keep the old building and you renovate the faith. And this has been done a lot. The people who pray in the cathedral today, they pray in the same building, they pray according to the same scripture, but I think what they do when they pray is probably a little bit different from what was the case 500 years ago. So one option is to renovate the faith. Another option, of course, is to renovate or repair the cathedral. This has been done 2 times. It collapsed twice in 1511 and 1888. I looked it up, and then it had to be partially rebuilt. And of course, this is something that happens. And thirdly, and I find that absolutely fascinating, of course, the place where the Sevilla Cathedral was built was a place where before there had been a mosque. Then that mosque, first of all, for a while was used as a Catholic cathedral. So what they did is they changed the priests. And one of the suggestions by Olivier is to change the priests. So instead of, say, the council having the ultimate say, they want the European Court of Justice, they're different priests, to have the final word of say. And of course, at some stage, it was decided by the citizens of Sevilla in the 15th century to tear down the mosque and build a new cathedral. And similarly, it seems to be the suggestion. So I think it's very interesting how the history of that cathedral can tell us what are the options to deal with changing circumstances, ultra low interest rates and much higher debt levels. We can renovate the faith, we can renovate the cathedral, and we can change the priests, we can tear down the cathedral, build a new one. All of it you have in that image of the Cathedral of Sevilla. And so I think in many ways it's a very rich menu. Now, obviously, in the immediate response to the crisis, we have done a number of things, and they were not mainly about renovating fiscal rules. What has happened is, of course, the fiscal rules, they are on holiday. I quite like at the technical level the way that the Commission has introduced a COVID dummy in their cyclical adjustment, which I think is a rather nice trick to deal with the present situation. And last but not least, we have Next Generation EU, so a major fiscal initiative with rather far-reaching consequences. And So one of the questions to look at from a policy perspective is of course, do we want to spend our capital discussing how to renovate or rebuild a cathedral, or that is this particular rule set, or maybe there are other political priorities that we need to work on. And my minister at some stage was talking about the potential Hamiltonian moment that this constitutes, and of course I don't think he had mainly the fiscal rules in mind, but rather further reaching consequences. So it's a question of where do you use your political capital, where you use your, where do you use your capital wisely, and rebuilding a cathedral is not a mean feat. So that, I think that's something that needs to be borne in mind. I happen to think that probably at this stage we don't want to tear down a cathedral and build a new one, but focus on a number of other issues. But having said this, there's, of course, there are two elements in the proposal that can be looked at separately. One is the question, should stochastic debt sustainability analyses be used much more in the context of either constituting the fiscal rules or interpreting them? And the answer is, of course, a resounding yes, certainly to interpret them. If they were to become an integral part of the fiscal rules, I just want to point out that we could have a certain number of problems. For example, if one does a serious debt sustainability analysis, one tries to tailor the parameters one uses to the country-specific circumstances. One could even use, for example, different S maxes as an assumption. Well, it's more likely that they can have a rather large fiscal surplus for a long time. And one could have different assumptions for different countries on interest rates. One could have different assumptions for different countries on growth prospects. And I can tell you, European experience shows that while from a purely scientific perspective, such tailoring may be attractive and even give more accurate results using all the knowledge at one's disposal, they would be highly controversial assumptions. So I'm not entirely certain how specific in the end the debt sustainability analysis, the stochastic debt sustainability analysis could be, if indeed this wasn't just a sort of a second opinion on certain fiscal decisions we're trying to take, but if that in itself was the law, and how, for example, courts would have to interpret differentiated or not differentiated assumptions on some of these parameters, I think that's something that one would need to think long and hard about. But as a certainly second opinion, helping to interpret the fiscal rules, that seems to be a very good idea. As for the questions, they're really questions that I've asked. I'd be very much interested how Olivier looks at them, if indeed the stochastic debt sustainability analysis were to become an integral part of the rules themselves. But let me move to the second very interesting proposal that's in there. You've said moving from rules to standards, but for me, the core part of your proposal is to say, well, shouldn't certain types of decisions be taken by courts rather than by the council? And we have, interestingly enough, we have such a situation with state aid, where of course the commission takes decisions and then they can be challenged in courts, and there's a large body of jurisprudence that gives one some idea. It's highly, state aid is a highly complex business, just as debt sustainability analysis. And it seems to work, more or less. Sometimes it's controversial. So that's an interesting suggestion. I just want to point out that, of course, the stakes are high in state aid cases, but the stakes are much higher in instances of debt sustainability analyses. And we're talking about the entire fiscal policy of a country. So there's an interesting question whether the fact that the stakes are higher causes a problem there. In principle, there is a European example of how it might work, but higher stakes could be a problem. and also imposing sanctions if it's a question of solvency or not solvency. As we all know, it's more difficult to punish a country that is insolvent for not abiding by the rules, whereas you know, levying a fine in case there's a state aid problem is a much easier thing. So I think these are also aspects that need to be borne in mind. To sum up, I suspect we will have to renovate to some extent our faith according to the changed circumstances. Maybe we'll have to renovate our cathedral a little bit, build an extra chapel. I'm not certain whether we're going to tear it down, and we should certainly learn some of the very interesting lessons that are in the paper, and see how we can use that sustainability, and also see how we can use the idea, perhaps, but I think that will need more careful consideration in the context of fiscal rules, of having courts a little bit more involved. That's a perspective from Berlin, and since I know there's some journalists listening, please let me be very clear, this is not the official view of the German Ministry of Finance. Thank you very much.
Thank you. I could be pretty sure that it isn't. The cathedral metaphor is going a lot further than I thought it would do. I'm delighted about that. Beatrice, would you finish us off, please, with your reactions?
Yes, happy to do so. And I have just decided, since I see how many Q&As there are, and that we really want to give the authors the space to answer, to ditch my presentation, which I have prepared, and say that I agree with a lot of what has been said, almost all of what has been said by the various discussants. I was going to add a little bit of color also from my side in terms of the fiscal framework story, my own personal story in a way. How have we been thinking about this? How have we been worrying about debt? So I'm thinking 10 years back, the debt redemption pact that the German Council of Economic Advisors at the time put forward, and which was a major issue. Then I was wanting to say briefly about another piece, the 7+7, which a proposal of which Jeremy also was one of the co-authors. In that, we also were worried about how to deal with debt and building the right incentives. The story of the rules themselves were part of it, but only one part. And then finally, ebook, which was published very recently and is the sort of state of affairs from beginning of this year, when at the EU Commission, the expectations of how much could be reformed had already been quite narrow, and it was focusing on the very narrow question of maybe we could start with a European Treasury, at least to start with. So in that perspective, I think this is a breath of fresh air. It's not only a cathedral metaphor, what Olivier and co-authors are putting here for what is in fact a proposal to rebuild a new cathedral. And let me point just one aspect that has not been emphasized by previous discussants. Everybody has said, yes, we don't want to worry about that right now, and we may not want to worry about it as long as R is smaller than G, and the fiscal cost of that may be very low. But yes, we have to worry about the fact that interest rates can go up very quickly, and there the discussion in a monetary union is quite different. And Olivier, you said, well, the range at which this can happen, the debt level range is very wide. But we also know that this debt level ranges depend also on the institutions in the country themselves, on commitment devices, but also on the financial safety net around them. So there is some endogeneity. Typically, in fact, advanced countries can sustain much higher levels of debt than emerging markets. So that's not just a given, and it's not only country specific, it's also specific to the arrangements around them, and to the global safety net, or to the European safety net in that case, and its own parameters. And that relates to a second point. Yes, the central banks can eliminate the bad equilibrium, but how much do we have to worry about fiscal dominance? And the third point is, if the DSA is the solution, it's not like stochastic DSAs are not being done. The IMF does them, the Europeans do them, but it did not really solve the question of whether Greek debt was sustainable or not. There was a big disagreement, as you remember, about the parameters. So what happens if you disagree? And second, what happens if, even if you, let's imagine you actually agree that it is unsustainable. You mentioned that then the countries would have to adjust, but can the ESM still lend to them if it is unsustainable? If not, then this is equivalent to setting the level for the restructuring regime, which would be the IMF approach. So that piece I was not, it wasn't so clear. That's of course one that we have been discussing at length. And last but not least, I wanted to show, but I can just say it in words. When you look at the IMF forecast right now, it would agree with what you said last. The next 5 years, debt levels for all European countries seem to jump up once and then basically stabilize, or in some cases go down over the next 5 years. That's the IMF forecast. Of course, that forecast does not include any bigger expenditures for the second wave that we may be facing now. And the very last point is, I think Michael had this, we are not only rethinking fiscal rules, we are also embarking on an ECB strategy review. Given the increasing at higher debt levels, the increasing interdependence between fiscal and monetary policies, this should probably also be considered. Thank you.
Okay, thank you very much, Beatrice. Now, this is the problem of having a standards rather than a rules-based timing policy, is that you all went over, but just by a little bit. So we have some time. We'll make some time for the questions because there are so many good ones, and I would like to get the responses of the authors specifically because, as Michael says, if you call the paper the BLZ, we've heard from the B, but not the L and the Z. So Jeremy and Alvaro, I wondered if I could come to you first on your responses to what's been said by the discussants.
Let me just come in just for a second.
Oh, yes, of course, Olivier, yes.
Which is, there are 41 questions. I didn't have time. I wanted to listen to the people who actually were speaking, so I haven't read all of them. I did basically commit, if you want, to answer all questions bilaterally or in some way if we don't have time, which is probably
that is quite a commitment. Yeah. You do know what you're taking on with 41 questions.
I will give 41 answers, not more, not 400. And then I'm going to leave the floor to Jeremy and Alvaro. If there is time, then I'll come back. But otherwise, I mean, thank you so much to the discussants and the panelists, because I think you asked all the right questions. I think we or other people can do better than we have. Thank you. Jeremy.
Okay.
Great. So thank you very much. It's been absolutely terrific. We haven't been trashed quite as much as I feared. Jakob has been extremely gentle and diplomatic. So I love the discussion. So it was being great. And I have pasted on all the 41 questions into a Word document. So just a few selective reactions. First, I want to acknowledge Jakob that at least in my intellectual development, he was actually the trigger for my discovery of standards as a solution. And the reason was that I presented a very, very super preliminary idea on sort of reform of fiscal rules at a BMF fiscal workshop in May of 2019. And it ended with basically me arguing that you need a ton of state contingency in the rules. And I wrote down on the blackboard a very long function, an actual function of everything that would need to be in the rules, at which point Jakob said, this is absurd. And that's when we gave up, at least I gave up on the idea of rules. Next point, very quickly, I want to clarify what is a terminology issue. This is in response to something that Bea asked. So, when we use the word debt sustainability here, as Olivier clarified, what we mean is sustainability on current policies, okay? which is not the usual way that debt sustainability is defined, say, as at an institution like the IMF, where basically lack of debt sustainability means there is no feasible adjustment that would put the debt ratio on a stable path. Whereas what we are looking for here is essentially the probability that the debt path will explode, conditional on the policy baseline that is the likely baseline. And so when this is violated, the first line of defense is to actually change policies, that is to adjust. So if we find debt is not sustainable based on current policies, this is a far cry from saying debt needs to be restructured, right? That would be a second step. So for us, essentially, what we mean by debt sustainability or lack of debt sustainability is essentially there is a risk of debt distress and some action needs to be taken. Okay, third point and most important point. And so this is something that Olivier just didn't have time to cover at the end, but we do favor a change in the enforcement institutions, in the institutional mechanism, in addition, as a complement to this change from rules to standards. And the way to think about this is that the problem that rules would not fit was fully anticipated in the pre-Maastricht discussions. You can read about this in this wonderful Princeton essay describing the genesis of the fiscal rules by Tommaso Padua-Schioppa and co-authors. And in effect, the compromise was we will have rules as benchmarks, but then exactly how they are applied will be decided by the European Council. And so we are going to give ourselves leeway to, in a sense, let countries off the hook on the rules if the rules are too absurd. The problem, and so another way of sort of making the case for approach, is that the way in which this customization was envisaged and subsequently played out in the stability and growth part is very inefficient, because what it does is it mixes debate on, is the rule appropriate to the current situation into a broader political log rolling and bargaining exercise. And so what you have in the current system is sort of these very rigid, firm rules, even though they have been made more contingent over time, as the starting point, and then you have a political debate at the enforcement stage. What we are basically arguing is, let's switch around the order of this. Let's have a technical discussion first that's based on standards, that's inspired by models, by debt sustainability analysis, by worries about what the right speed of adjustment is. Then you have a recommendation by the European Commission, which would need to have quite a lot of weight. It would need to be able to block, for example, a draft budgetary plan when it violates the standard, which is more than what is the case right now. And then after you have, all the soft stuff is in a way in the standard, the enforcement should actually be hardened. And so we would then, in the sense of depoliticizing it. And this is why, in the paper, our preference would be to give this to a truly independent judicial body, even though, of course, it needs to be a specialized judicial body because of the important issues involved. So that is, in a sense, the grand bargain that we are proposing. So this now gets me to and by the way, just in response to Davide's question, the burden of proof, there would not be a burden of proof. So this is not a criminal law model, but it's one where the commission makes a judgment and basically the country argues against, and then the judicial authority needs to arbitrate in a way, decide who's right. But there's no sort of, you have to prove beyond reasonable doubt and none of that stuff. Okay, now this brings me to the central point of critique of Jacob, which is the Hamiltonian moment. So basically Jacob's critique was, look, this may be nice and perhaps important, but we don't really even need to have this discussion apart from, getting some ideas out of the paper that might help at the margins with the reform of the SGP, because this is obviously going to be politically very divisive and we have bigger fish to fry, the Hamiltonian moment. So basically what he's saying is that the moment we should really, the opportunity that we should seize here is greater fiscal integration, more risk sharing. That's the way I interpret his comment. Now, my point here is that our idea on standards, particularly if you take it together with this idea of making enforcement more objective and in a sense tougher, could be very much part of the quid pro quo of this Hamiltonian moment. It could actually be the glue that makes this whole thing work, because it could be combined with a higher degree of devolution of authority to the central, or bumping up authority to a central EU level, right? So the quid pro quo could be for the Germans to say, look, we are going to allow a greater fiscal integration, and we are going to take a more sort of situation-driven view of debt sustainability, but only if in the end the power of central EU institutions, including independent institutions like the ECJ, is strengthened, so that this whole thing doesn't in the end boil down to just an anything goes free for all, right? So I would view our idea as part of a package of what could be done. And then a very small question that came up in the chat, I was asked whether the IMF, and by the way, of course, I should have started with a general disclaimer. This is absolutely none of what we have in the paper or what I've just said is the view of the IMF. But on this point, I can speak on behalf of the IMF. Namely, the question was, what about these stochastic DSAs? If they're so great, why are you not doing it? And so the answer is, at the fund, we have been developing a framework for the last 3 years, and it will be hopefully published by the end of this year. And it's going to be great. You're going to love it. And if you apply this framework to Europe, everything will be solved. That was ironic, but let me stop here.
That's a good place to stop. Thank you. Thank you very much, Jeremy. And Alvaro, please, any comments you have, because you've really earned it, because you read you read the rules.
I have, but Olivier was being humble because they have read them too, and I'm surprised they're still alive after doing that, and we're still here to discuss them. But I just wanted to react really quickly to a comment by Jean Pisani-Ferry, because when Olivier said, well, we have the general escape clause this year, the rules are suspended until the end of 2021, so we still have a year to figure things out. And Jean answers, well, we don't have that much time. We have to actually figure everything out and have the new rules in place by 2021, by the end of 2021, so we don't have that much time. So to me, I think this illustrates the problem with the philosophy we have now and of the proposals that have been made to reform the rules, which is namely to have a simplified rule that doesn't cover for every single contingency, but then we have this great big general escape clause in case things go south and the rules would require something that is completely unrealistic. But then what happens now? This general escape clause, it's an all or nothing. So now we have to either figure out in a year what's going to happen, because the post-COVID world is going to be completely different, and we have to, and the rules that we had before would require a very strong adjustment, or we have to change the rules. So I think this general escape clause strategy gives us a false kind of confidence that, yeah, everything will be okay. When things get really bad, we can just suspend the rules and then go back to normality. But this isn't the case, because these big shocks actually change the facts on the ground. So that was the main comment on the general escape clause I wanted to make.
Okay, we are a little over time, but there's just a couple of the questions here that I wanted to throw open to see if anyone does have an answer to it. And one of those was the question that David Miles put in, which is to say, we sort of abstracted away from what these externalities are of the individual country running large deficits. Could it be that those externalities might be large enough to justify a rules-based regime, no matter how imperfect the rules-based regime might be? Does anyone have a comment on that?
Olivier, do you want to take that? I mean, I think it's implicit from your presentation.
You're muted, Olivier.
Jacob had his hand up. I don't know if it was to answer the question or to ask a question.
Okay, I'll let you both comment on it. Yeah, absolutely.
Okay, so my sense is yes, that externalities are a real thing, and they justify, from a conceptual point of view, the need for EU level rules. I suspect that there was more than that at work, which was the notion that governments really were not going to behave well, even from their own interest, that politicians had to turn an horizon, and this was a way to make them behave, which is an argument conceptually separate from debt externalities. But the debt externalities argument is a real one. We saw it at work during the Euro crisis. And I think it's a justification for EU level rules. Well, rules, I'm sorry, for EU level standards.
Mm-hmm. Jakob, what would you like to say?
I mean, I just wanted to add a point that brings a little bit something, David's question and your remark by Jeremy together. If you look at the US, they have a pretty good US Treasury. And as a result, it's perfectly all right in the US to have very stupid fiscal rules. I mean, they're not at all sophisticated. They have nothing to do with stochastic debt sustainability analysis for the individual states. And that's fine. And so in a way, my suspicion is the reason why we're talking about this, why we're not talking about stupid but simple and easy to understand rules for individual member states, is precisely because our EU Treasury is very much still being developed. And my suspicion would be, as we move towards having a more functional EU Treasury, maybe some of the complications that we're talking about will become slightly less relevant. And the externality that David pointed to may in fact indeed become the dominant force, which would then call for relatively simple rules. But that's just sort of one way of thinking about it.
Yeah, Jacob is right. And the general point, some questions actually were about this, which is that there's some interaction between the fiscal union project and the fiscal rules project. And in a world in which the fiscal union was perfect, a perfect union, then indeed you could have very stringent rule at the national level, because the EU level decisions would be perfect and to take everything into account. We're not going to get there anytime soon. And therefore, I think for the moment, the discussion is quite relevant.
Can we have one final question just to wrap up? We're way over time, but this one's been top of the list for such a long time. And the question is basically, if we look back in history, if we'd have had standards instead of rules, would we have had austerity? Olivier, you really have to take that.
Yeah, I mean, my sense is, again, I would want to see the stochastic DSAs be done retrospectively. But yes, I think the arguments we were giving at the time in saying that it was too early to contract, that the output cost was too large relative to the decrease in debt, which could happen, would have been borne out by an SDSA.
I think we certainly are out of time. Thank you very much, everybody. Thank you very much for those questions as well. And thank you very much.
Let me make a credible commitment.
Yes.
My email is ojblanchard@gmail.com, and you can ask your question and I will answer it.
That is a very credible commitment. Thank you very much, Olivier. I really appreciate it, because there are some excellent questions there, really deeply thought through questions, which shows, it shows how good the presentation and the reactions were, but also thank you to our audience for giving it your attention at the moment. So that brings to the end our panel today. As many of you know, the conference carries on. We're looking at climate change tomorrow for more sessions there, and some of those look terrific. But from all of us on the panel, I will have to do a simultaneous wave to say goodbye to everyone. But yes, that looks great. Thank you very much for staying with us. Thank you for your questions. thanks very much, most of all, to the panel for the presentations, and we will see you soon. But from me, Tim Phillips, goodbye.
Thanks so much.